Hi, welcome to this week's The Mortgage Broker broadcast. My guest this week is Jonathan Needham, and I wanted to get Jonathan back onto the podcast because just following on from the solo episodes I've been doing recently about changing the market and the whole mortgage world, I wanted to get his take on it. He's done a bit of piece recently about the removal of the advice trigger and the paper that the FCA did in July last year. So I just wanted to get his take in terms of the way the industry is going. What effect does the removal of the advice trigger have on the industry, and get his opinion on that. And also as well, we've been doing the Broker Foundry, which has been a podcast and a YouTube channel that we've been doing recently. And what we've decided to do is bring that, rather than doing episodes of the Broker Foundry, having a different channel. Jonathan and I just thought it was better to bring Jonathan as a bit of a more regular guest onto this podcast, rather than creating something totally new, just using this platform, getting Jonathan on as a guest, a bit more on a more regular basis, and then get his thoughts and opinions on various topics within the industry right now. So that's why Jonathan's back on, and talking about the removal of the advice trigger, getting his opinion on that, and just seeing where the podcast goes. So let's just welcome Jonathan onto the podcast. Welcome back onto the podcast, Mr. Needham. How are you?
I'm very well, Craig. Thank you for having me back. I really appreciate it.
No, thanks. I appreciate you coming back onto the podcast and having a chat. We'll probably, I've done a bit of scene setting about the Broker Foundry on the intros when you weren't here. So just to explain a little bit about that and why we sort of moved back into this sort of thing. So I'm hoping that we can get a few regular spots on this podcast now, mate, and a few more guest episodes with your take on the industry, which I think is always important and always entertaining.
Well, absolutely. I try my best. I'd be delighted. And I think, as we've discussed previously off air, it sort of simplifies it for us, and appreciating my current capacity with what we've got going on at Cornerstone and different things. So, I think it's a much better sort of platform for us to engage. And it's always good to catch up with you, mate, as you know.
It's good to have a chinwag with a fellow South Yorkshireman, so that does always help. So no, I appreciate you coming back. And like I say, it's definitely the right platform for this sort of moving forward. So getting straight into it, and what the reason why, and I appreciate you coming back on and sort of trusting me with no agenda and throwing these sorts of things at you. So for the past couple of weeks, my podcast have been doing some solo stuff around client retention and a few other bits as well. So I know you sort of did a piece recently about the removal of the advice trigger. And I just wanted to sort of I've got my own thoughts on it, which we'll chat through because we've not even spoke about it, and get your thoughts on it. And let's just have a chat about the removal of the advice trigger and the piece of paper that sort of came out. Is it about July last year that it came out?
July 25. I think, I think we have to be sort of mindful that we're operating in a regulated environment, and far from it, from me to sort of be controversial in any way, shape or form. However, I think we've got a couple of clues currently that kind of points us in a little bit of a direction. And the paper that came out last year probably is one of those clues. And for those of you who haven't read it, and I'd certainly encourage you to have a look through it, bit of bedtime reading, but in a very simplistic kind of way, it broadens the scope for lenders to engage with clients whose deal is coming up for review, quite simply. That is it. And, maybe when it comes to product transfers, we're in a little bit of a perfect storm currently. So, maturity, boom, record number of remortgage or maturity transactions coming up. And then we've got the lenders who are able to engage with clients directly a little bit more than they perhaps have been previously. And you don't need to be a rocket scientist to put two and two together and think, well, maybe they don't need to go and build or rebuild sales forces because there's the potential to create some kind of AI solution. I don't know. And then, in addition to the removal of the advice trigger, the other clue that we've had is, a fairly big lender within the market has reduced the prop fees that they're paying specifically on product transfers. That happened, I think, just before Christmas, maybe a little bit before then. And you kind of think, well, is this a precursor to lenders stopping paying prop fees on product transfers? Full stop. What do you think?
It's a really good point. I think there's sort of I think there's too much noise. When you start looking and start delving into things, there's certain things that make you aware that there could be some changes happening. So you've got some lenders. I'm not going to start naming. We're not going to start naming on here because you can find the information if you want to find it out. But some lenders recently, I feel, have gone quite vocal in terms of saying about how they see brokers as instrumental in their business. There will always be space for brokers. They'll always want to work with mortgage brokers. And we're talking about big, we're not talking about sort of like the smaller specialist ones. We're talking about big high street lenders. They've been very vocal around we see the future working with brokers, which is obviously that a trigger on the back of another high street lender who we won't name, who is then, like you say, reducing the base points on the retention, the product transfers, but also as well holding their cards. You ask the right people about what are they doing with regards to AI integration, client retention, and they're playing the cards very close to the chest and disclosing very little in terms of what they're doing. Starts to then thinking, in my mind, well, somebody's been vocal about how integrated we are. Somebody's then playing the cards close to the chest and sort of reducing the retention rates. Then, well, what kind of message does that sort of send? And I think they are quite clear messages within our industry that things are going to change, particularly around the product transfers. And I think, like you sort of said there, product transfers for me is big, and that's no. If people listen to this podcast before, I've already said on the podcast a few weeks ago, maybe a few months ago, that if you're a broker that purely relies and all your business is product transfers, you need to do something now. You're at risk. And whether we proved right or wrong, I'm not really too bothered. But I think you are at risk. If your business is purely on volume PTs, you may struggle in the market long term. Now that might be, you might not be bothered about that. You might be thinking, well, I'm getting out, got an easier life. I'm just returning my existing clients, just doing PTs, don't charge me fees, don't talk about protection, don't do anything else. Well, if that's your way that you work, well, you've got good, and that's that you've not got longevity within. I would say, in my opinion, you would not have longevity within your business. Whereas, as we've alluded to before, and we talked about before, if you coming into this industry as a mortgage broker, new into industry or failing, or it doesn't matter, like 1 year in, 2 year in, 5 year, you're in this for the long term. You don't become a mortgage broker and think, do you know what, I'm just going to do this for a year, kick a few tires around and then sort of go on to do something else. You're just not this, you're in this for the long term. So if you are in this for the long term, it's starting to think, actually, what does my business model look like? What does my client demographic look like? All these kind of things. What does my website say about me as a business? What does my social media say about me as a business? Because you've got to start to be aware of these things because, the world of mortgage broking, there's no doubt about it. The world in general over the next 5 to 10 years is going to change. Nobody knows what the world is going to look like. You ask anybody, even the people that are controlling AI, don't even know where this is going to go.
No.
So
Well,
it's important.
I mean, let's face it, nobody really knows what's going on anyway. Not just within our industry, but I think you're right, and it goes back to what's the saying? There's three things that we can be certain about. Number one, we're going to die. Number two, we're going to pay taxes. Number three, things will change. Change is a constant in life, specifically within the mortgage market, I suppose to a certain extent we have taken advantage of the fact that lenders decided to pay procuration fees on product transfers. And we're now in a situation where we are perhaps questioning whether there's any real longevity within that. I personally don't think there is. And I think there's an opportunity, and it's conversations that I know you and I are having all the time with advisors around future-proofing your brokerage. And that is starting to look at developing other income streams, whether that's, looking at more specialist areas of lending. Because my view is there will always be a need for an advisor when it comes to more sort of specialist areas. And by specialist areas, I think equity release would be one. I think we are in the midst of an explosion around equity release or later life lending in particular. As a society, we're living longer. We are equity rich but cash poor. And regardless of what your attitude may well be towards equity release, I think it's a perfect solution for hundreds, if not thousands of people. And that area is only going to become more and more sort of familiar to people, especially when you consider what's going to happen with inheritance tax and the fact that they're introducing pension pots into people's estate values from 2027. The nil rate band's been frozen until 2031, I think. So again, all indicators are suggesting to us that equity release as one area of specialist lending has the potential to grow. I think, having read an article from the FCA's chief executive, I think it's certainly something that the regulator wants to bring more mainstream as well. But when it comes to specialist lending, I'm not just talking about equity release, commercial finance, bridging, second charge, all those areas where you cannot create some kind of AI solution. There would always be a need for an advisor. I don't think we should fear AI or technology. I think we should welcome it with open arms because it may well mean that, it swings and roundabouts, isn't it? We might lose proc fees being payable on product transfers, but equally as well, it may well drive an efficiency into what we're doing day to day. And that can only be a good thing for advisors and also the industry. But for me, it's about, I think it's a healthy thing having these types of conversations because, the alternative is to bury your head in the sand and just think, oh, well, that's never going to happen. Lenders will never stop paying proc fees on product transfers because they'd never do that to us as advisors. Because if they did, they're going to run the risk of damaging the relationship. Well, let's face it, the reality is, I'm not entirely sure whether your bigger lenders care that much, in all honesty.
I think that's the realization that these is gone are the days of the the partnerships and the cooperate, like all those kind of things. These banks and building societies are large corporations that have got a board and investors and all. So they all they're bothered about is whether yes, there's certain messages that will come out. However, ultimately, they're run by these people that are making decisions that are far higher up in terms, and all they're bothered about is the bottom line and return on investment. That's what their target is, what the return on investment is. So if they can sort of see that all of a sudden cutting out, they can manage it effectively and efficiently in-house, saving X amount of pounds per year, and that goes straight onto their bottom line without having really any impact on turnover and client service and client journey and client retention, well, and that sort of, they're going to start to turn a few heads as soon as somebody starts to make more money. Then there's going to turn a few heads from other
I mean,
places.
it's a commercial decision, isn't it? And I think, you know, if you and I were in their shoes, we'd probably be looking at it exactly the same. And my attitude on this and the view I have isn't, you know, let's bash the lenders, the banks and the building societies. Far from it. I've got some fantastic relationships with, you know, all different shapes and sizes. And, you know, they've been incredibly supportive of me and some of the initiatives that we've been on with over the last few years and more recently. It's not about that. It's about having a grown-up adult conversation with advisors. You might want to think about this, because if it does happen and you are solely reliant or heavily reliant on the income coming from prop fees, then it's probably a good idea to start thinking about future-proofing now than getting caught out. So I don't necessarily, you know, I'm not being negative in any way, shape or form towards the lenders. I think it'd be a purely commercial decision. Would it damage the relationships with the intermediary market? Probably in the short term, but everybody just kind of gets over it and gets on with it, don't they?
And that's the thing, and that's just part of the change that's going to happen within the industry. If that does happen, I say people just get on with it. You're not going to stop placing cases with a particular lender because all of a sudden they decided to stop product transfers, because you can't do that, and you shouldn't do that, and you won't do that, because it's like you say, it's about, you said about the three things. I think the one thing that you have some control over is about how you adapt to change. That is, you know what I'm like. I just focus on what you can control. Don't worry about anything else. Being aware of other things, but it's very much around focusing on what you can control. You can control how you adapt to technology, how you adapt to AI, and the world that's changed within mortgage broking. You can't influence it, because the world, the lenders, the banks, the building society, all these things, it is going to be what it's going to be. You've got to stop. Don't put your head in the sand. Be open to AI and being aware of, actually, this is like a bit of a, the difference is, mate, and I think when you look back, we had warning signs 2007. We had warning signs 2007 for what was going to happen in 2008. So we had warning signs 2006, 2007 to what happened in 2008 with the crash. But we didn't do anything about it, because it was just, oh, good times going to continue, and we're going to, oh no, all these things. Oh, you just put your head in the sand and not worry about it. Whereas now, I think it's that part in this industry to think, actually, we are going to change. Change is going to happen. So as a broker, we're going to get onto in a second of, I'm going to ask you the question of, if you had your own brokerage right now, what would you do? And we'll have a chat around that in terms of giving, like I said, this is not about doom and gloom. This is not about being negative. This is about the realization that the world is going to change within the next X amount of years as a mortgage broker. So we've got to do something about it, and doing something about it now. So the brokers that are switched on are already looking at thinking, well, I need to adapt to the change. And if the change doesn't happen, but I've adapted my business to be prepared for the change, and it doesn't happen, then, well, great. You've diversified your business. You're more likely to grow. You're more likely to be here for the longevity. So it's that aspect of it that And and sometimes you've got to look at as a human being whether you adapt to change or not as well, because people don't like change. That's just human nature. People don't like change. However, it goes back to the change I can control and the change I can't control. And this is what happens within the industry is beyond your control. So you've got to think about, actually, if then AI technology AI comes into the workspace a lot more from an industry point of view, and what we're potentially seeing with the lenders. And yes, it will speed up the process, more efficient, hopefully streamline all the bottlenecks that we have in our world, and the house buying process and the home buying process, all those kind of things. So there's the massive benefit of it. And it's been the same thing what happened in 2008. Look how many brokers left the industry in 2008 because they weren't prepared. They weren't ready for it. They were used to earning all the money, used to all the easy life, didn't want to adapt, didn't want to change. The world changed overnight and they left the industry. That's what happened. Well, actually, and that will happen again. That will happen again to certain people. Now, if you're listening to a podcast and you're aware, whether it's this podcast or any other podcast, and being aware of what's happening and the signs within the industry, you're not one of those people. You are more open to think, actually, I do need to adapt. I do want to learn. I do want to change. And so that's the whole point of this. This has not been the negative of the industry that we're in, or against the banks or anything like that. It's just the realization that we are sort of seeing. I'm seeing it, you're seeing these certain things that actually means that, well, you need to start doing something about it now, because when that does happen, you don't have a year of no income, 18 months of no income, 6 months of no income, because you then don't know what to do, you're rabbit in the headlights, and then you figure it out post-apocalyptic meltdown, you figure it out then. Figure it out now. Have that plan B, have that plan C, have that plan, because then when it does change, which it will, you then literally that you're straight into and so it won't affect your income, your livelihood, your lifestyle, and everything else that comes with it.
Do you think if as a consequence of change, and I don't know if it'd be to the scale of being apocalyptic, but I get the sentiment. I will get the sentiment. But and if as a consequence of that, the industry loses a portion of the advisor population who may well, and I don't mean to sound in any way disrespectful here, but who sit and are literally just writing proc fees, pressing buttons, charging a fee, next, move on. I've heard to people in the past there's just been order takers, focused entirely on, sort of transactions rather than building relationships. Is it a bad thing if the industry loses those types of individuals?
I don't think it is, because I think as a consumer, it's more than that, isn't it now? You want more. You want more from your mortgage broker. You want more from your financial advisor. You want more from these individuals who you are paying for. You've got the trust in them. You don't see it as, you want somebody to actually feel like the part of your journey of what they know what you're trying to achieve. They're helping you achieve that. They've been open and honest with you about the realizations of that. And it stems back to, it's about education. And I think that's the thing, is like, there's not enough education from the start as young adults in terms of the whole financial thing. So I think that's sort of the relationship, because when you look at it, I think we're getting a bit sort of, I will stay on point with regards to the whole AI thing, because there's going to be certain things that people will use AI for, and there'll be certain things that actually I want to know that I'm speaking to and I'm seeing Jonathan Needham, because we like now we could put up. I could create this podcast. I could just get AI to create a script, put that script into software. It would then create a podcast, me and you talking, so it would look like you and I were talking, and we wouldn't have to worry. Like, we wouldn't have to be sat here talking, wouldn't have to be...
Even our accents.
Even our accents, mate, yes. Even our accents. There is enough content. There is enough content. We'll have used all the words that we need to use at some stage. This out in the public domain on some video somewhere where it will then scrape it and create that content, and it will literally be, there you go, and we won't have to worry. But actually, are we adding value by that, by creating the scripts in AI, then transposing that? So my point with it is, which there is a point, that people will want to do, there will be certain things people want AI to do, and hopefully help all that thing. But we are human beings, and we will want to know that we're talking to a human being, dealing with a human being, speaking to a human being, get the thoughts and opinions and choices and all those other things of a human being. You can already see it now on social media where you've got no idea what is true and what's not true. So because you already see, like, you see the BBC verified or whatever it is to show that actually this is not some sort of random made up thing in terms of how much click do we get now in terms of like stuff in YouTube which is get fed to you about, and we just sort of like just somebody that's created something just for clicks. It's like, no, like people value that interaction with a human being. So and because we all know that buying and selling your home and dealing with a mortgage is such a massive financial burden, financial expense. Somebody's dipping into our bank account every single month and taking hundreds or thousands of pounds. We want to know we're trusting those people with what's going on. So I think that's sort of like, so those people that are transactional. So my point is, those people that are transactional, the broker that just do click the button, take a fee, next kind of thing, and do not know names of kids, do not know why they move into that street, why, like all those kind of things. I think those people will go because, and the beauty of it is that, so there'll be more mortgages to go around because people will be expecting more. And that's too much hard work for those individuals to understand the ways that certainly we work in terms of personal, knowing our clients, knowing where they live, knowing what the names of the dogs are and the kids and all that kind of thing. People want that more. The beauty of AI is that because this process will be so much smarter, we will have so much time to have those conversations, whereas at the minute we feel like we don't because we've got the next application to do, or we've got this lender's chasing this, or we've got to get this and this and all those. So in fact, as a mortgage broker, you will need to have those personable skills and have that curiosity to understand more about the person you're dealing with, and you need to feel rewarded by that, by the conversation happening. And those, like what's the biggest motivation when I was a broker and doing it, the biggest motivation was those emails and those cards and those presents that you used to get saying, thank you so much. And literally would not have got more, we would not be here without you. And do not ever lose sight of that, because that's going to become even more heightened in the world that we're going to see. And so I got a bit passionate about that. I got a bit carried away with all that whole thing, but I just
no. I think it were very relevant. Do you think there are things we can learn from sort of the wealth environment post RDR, and how sort of they? Because I'm not entirely sure as mortgage firms and mortgage advisors, generally speaking, we seem obsessed with finding that next new opportunity. Where's my next lead coming from? And I don't know whether we spend enough time just putting the handbrake on and looking what's behind us at our existing client book, and perhaps working a little bit more effectively, as wealth advisors do. So
really good point. And from the fact, having a conversation with somebody about that exact thing today, like earlier today, I had a conversation with a broker, and I was talking to him about the change in terms of mindset of that this is no longer a transactional industry. You've got it's far more about relationships. It's more about annual reviews and them understanding what I'm going to talk about. What am I going to like? Annual reviews. Why do I need to do that? And that's where that is a very different mindset and way of thinking with the financial advisor's way of thinking, which is again about why are you doing this? Why are you moving there? Where do you want to do this? Why are you putting £50 a month away to your pension? What's your long-term plans? What's your long-term goals? All those kind of things. I think there's going to be a lot of merging with regards to the roles. And one, they're not seen as that financial advisor anymore and that mortgage broker. And they've got two different distinct things. I think it's a case that as mortgage brokers, we've got to learn to have that more of a advice and educational piece and see this as a long term than a transactional, and you might not use me again in 5 years' time because the lender's going to be touting you and I do nothing to retain you as as a client.
Well, they're not going to remember you, are they? So, I mean, if I paint a brief scenario, and let's assume for 1 minute that an advisor has, as part of the arranging the mortgage, they've had an effective protection conversation, they've identified some shortfalls, they've established a budget, they've made a recommendation, the client hasn't accepted the full recommendation. Let's say that they've taken out some life and a bit of critical illness cover. And they wanted to press pause on the IP, the income protection. I don't know what the percentage is. I suppose this is a bit of a rhetorical question, but how many mortgage advisors or mortgage brokers currently would diarise that and go back in 3 or 6 months' time? And I'm not entirely sure whether it would be a high percentage or not, because, and you've touched on this, the reality of an advisor's life is it's busy. There's loads of stuff going on. And thinking that going back to Mr. and Mrs. Smith to discuss, whether now's a good time, they've had a couple of months mortgage payment, is now a good time to look at that income protection. There's just no capacity in the diary. However, if there are more of us starting to talk and shine a light around the importance of maintaining longer term relationships, and with the advent of AI, that allows us to have more capacity because we can drive an efficiency into what we're doing day to day, then surely that's a good thing, because ultimately all we should really be focusing on here is the client outcome. So what's right for the client? What's right for the client in that brief scenario is that we revisit them in 3 to 6 months' time and we have another conversation with them about, right, what are your thoughts now? But I don't think we're doing enough of that, because we've got, and I am generalising now, mate, but we've got this obsession about, right, I'm on to my next lead. I'm on to the next new thing.
Yeah.
It's like we're addicted to it. And we're not doing enough with the people that we've already transacted with.
No, we're not. And I think that could be various reasons, you think. I think sometimes for brokers, it is that fear of rejection. So if they've cancelled their IP or they've not taken up the IP, we're using the IP as an example, and there's no plan in the diary to follow it up because of that sort of, they don't like having that uncomfortable conversation with the client in terms of, well, these are the reasons why we need to talk about it. These are consequences of not having those things in place. Because that new lead it's new in it. It's like something new. We sort of like that new car. It's that sort. You look at like it's the new thing that's sort of like, oh, this is all great. Once they become a client, Well, I thought they just took the client now. I don't need to worry about anymore. You need to worry more about your clients than you do new ones.
Yeah. And I think this is my point. It's that there needs to be a shift in thinking, because I would bet you if we replayed a similar scenario, but on this occasion we're talking about a wealth advisor making a recommendation to a client to be paying X into a pension scheme, and the client declines the recommendation and they end up going for a lower amount, why would the wealth advisor revisit that client in 6 months' time?
Well, they're in this for the long. That's a different mindset. They're in this for long term, because then it's a case of they've taken whether they're putting in 10 quid a month, 50 quid a month, 10 grand up front as a lump sum, doesn't really matter. The financial advisor sees this as a long-term relationship, because that £20, if they sort of say, well, in order for you to retire at this age with this income, you need to be putting X amount of pounds in per month. And they say, well, I need to be doing, well, I can't afford that right now, but I'll be putting 20 in. If at some stage, well, not if, at some stage, that client's going to say, do you know what? Jonathan told me that I need to be putting £50 a month in, and it's been a few years now, and I've only been putting £20 a month in. I'm not. The consequence is I'm gonna have to retire at 70, not 67. I don't want to do those extra 3 years. Right. I've had a pay increase. Let's forget all about that. I'm now going to up it to the £50 to what Jonathan told me to, because they will have that realised. And so, but the advisor, by having annual reviews, are they on track to achieve what they want to do, where they want to be, when they want to be there? Because that's a different way of thinking. There's no fear of rejection, shall we say, because, well, there's still that long-term goal, and the client said that I want to retire with this amount of money when I'm 60, 50, 40, wherever.
I think we can learn an awful lot from the wealth arena in terms of how they build relationships, how they maintain relationships, and as you've just said, it's perhaps a bit of a shift in thinking that this isn't just, it's no longer about transactional relationships. It's about establishing and fully understanding what's important now, but also what's going to be important next year and the year after and the year after that and the year after that. So I think.
Go on, sorry, go on. I'll let you finish and I'll ask you a question about
No, you're all right.
Your viewpoint and a lot of things that you do, which brokers don't always sort of see, depending on who you're talking to, is that they sort of see what's their route out, what's their way out, what does that business look going to look like, what's the value, what is that going to give them, what's all those kind of things, which I know you talk to brokers and business owners a lot in terms of that. What having that mindset of financial advising way of thinking, what impact is that going to have on the valuation of that business compared to old school, shall we say, way of thinking of transactional?
Well, I think for a start, if you're running a brokerage that is purely transactional, there is no value to that. Especially if it's got, Jonathan Needham or whoever's name above the door, because what would somebody be buying? They're not buying anything, are they, really? So I think when you start considering, let's say that an individual is running a mortgage brokerage, and the reason they're doing that is because they're focused on an exit at some point in the future, then the types of things that we would be discussing with them is, well, for a start, some quick wins. So have you got a GI book? Do you recommend GI to your clients? Because let's face it, the only condition of any mortgage offer is you've got to have buildings insurance. But we just seem to walk past those opportunities because our general belief is that, and yet it's going to build 70% of GI automatically renews. So straight away, there's an opportunity there for you to create a value within your business. And in addition to that, It's looking at how you accept your protection commission. And I appreciate, we live in a world where we pretty much eat what we kill. But maybe there's an opportunity for us to start migrating to a situation where we take 25% of our protection commission on the drip or on a non-indemnity basis, and then we can migrate it to 50 and 75 and 100. And the relevance of that, well, first of all, you're de-risking your business.
Mm-hmm.
Because all, let's face it, all protection commission is paid up front as an interest-free loan for 48 months or however long. But by taking your protection commission on a non-indemnity basis, you're de-risking your business. But again, you're adding further value. You're able to demonstrate a reoccurring income.
Mm-hmm.
And then in addition to that, it's, well, who's your clients? And are you able to demonstrate to me how you keep in regular contact with these people? Do you keep in regular contact with them? So everything I think that we've spoken about, not just today, but previously, all sort of points towards, well, the people operating in the wealth environment are doing that already, aren't they?
Yeah.
And I'm not saying that we copy them, but I think that there are things we can learn.
Yeah, definitely. Yeah, and I think I'm not sort of saying, and I agree with you. I think I appreciate you answering that honestly, because I think that's the sort of thing is that if you can demonstrate, there's my GI book, there's my protection non-indemnity book. I keep in touch. I speak to my clients, like there's a 12-month communication plan, like whatever that looks like. If you can then demonstrate to somebody, like, this is what it is, this is how I do it, this is the regular communication I have with my client, that valuation of that transactional business, that transactional sort of way of sort of thinking, but is heightened and increased because it's the clients are used to a different way, like, and we've seen it more, and that, a financial, whether we like it or not, a financial advisor's business is worth far more to somebody buying it than a mortgage broker business is. That's just and I'm not sort of saying, well, we need to have paraplanners and all the rest of it in terms of that kind of stuff. I'm not, but AI can do a lot of things.
Learn.
It's just that shifting mindset. Absolutely, stuff we can learn. And I think the thing is that as a mortgage broker, you should be working fairly closely to a financial advisor because you're going to get opportunities. Whether you can spot them or not is another thing, but you should be working with a financial advisor that you know and trust, that's going to do the right thing by a client, not going to steal all your mortgage and protection, not all those things. If you've got that partnership there with somebody, you can sort of have that conversation, sort of see what they do differently to you, then maybe that you can learn from in terms of how they talk to clients, how they maintain relationships and things like that. I'm not talking about doing more work, because we're going to be working smarter.
No, absolutely not. I'm not in the business for doing that, Craig. I can tell you.
No, I know that, mate. But I think that's the thing. Like, people are listening to this thinking, "Oh, this sounds well and good, but I ain't got time right second to do this or that." You will. If you adapt and embrace and don't put your head in the sand, you will have more time to build relationships. That's the whole benefit of what we're going to see over next number of years. So, but I think, like you say, I think it's a whole shifting mindset that people have got to be changing.
And I think ultimately it's driven by being brave and having courage. Because the easy thing is always to do nothing. That's the easy thing. The easy thing is to carry on doing what we've always done. What is it? The definition of insanity is continuing to do what you've always done but expect a different outcome.
Yeah.
Definition of insanity. It takes a bravery, it takes a courage, it takes planning. It probably takes sitting down with a blank piece of paper and thinking, right, well, where do I start? And as I said earlier, a quick win for me would be just introduce GI to your proposition. Consider taking part of your protection commission on a non-indemnity basis. Not all, to start with, because I appreciate and respect the pressure that's going to put on cash flow. But
or you could split it, like we've talked in the past about sort of anything under a certain amount per month, take up front, anything above that certain amount, work out what figures work for you. Like you say, you don't want to have an impact on cash flow because, as we know, cash flow is very important.
Well, absolutely, and again, I don't want to sound like I'm now bashing the providers. Moved on from the lenders, and now we'll have a go at all of them. But I don't know whether there's more that the providers could do to perhaps encourage advisors to be taking the commission on a non-indemnity basis, or as we all refer to it, as on the drip. I don't know whether it suits some providers that everybody takes it up front. Who knows? Maybe that's another subject altogether.
That could be a whole topic altogether, that, mate, to be fair. So, but I think the whole point of this, and it's been quite different, this podcast, because like normally it's me interviewing the other person, speaking sort of like the 80-20 rule, as well as I've been sort of interviewed on my own podcast, which is not bad. Like, it's been good to get sort of both our viewpoints in terms of where we're thinking this world is going. But so just to summarize, clarify, I'm a broker right now, and I can sort of see things are changing within technology. Things are happening, and you've alluded a little bit in terms of a few things that could change. If you was a broker, you set up your own firm today, you know the industry, you know that you are where you're at. What advice would you be giving somebody who was setting up their own brokerage?
Good question. Thanks for putting me on the spot. I think the first one would be don't have all your eggs in one basket, which probably summarises what we've been discussing about looking at diversifying income streams. And that's not necessarily about, being a jack of all trades and a master of none, but just really think about what areas you're going to focus on. Have you got some areas of specialism, which I'm a firm believer will always maintain a relevance and it'll future-proof. I think, and your position on things like social media, whether you like it or not, that's your shop window these days. So you've don't cut corners on that. Spend as much as it needs to cost, as much as it needs really to present yourself to the world in the right way. And something else we've touched on, and that is always stay within your circle of influence. So always stay focused on the things you can do something about, rather than worrying about things that you may well have an opinion of, but you've just no influence over. The honeypot is absolutely key. So, by honeypot, that's your lead source, having people to speak to. If you've got people to speak to, you've got a business. Yeah. And then the final one would be something that I've been speaking about a lot recently, and that's product density, which basically means don't just flog them a mortgage. Think about the number of connections that you've got with your client, going through a full holistic process, making sure you're having the protection conversation, identifying shortfalls, establishing a budget, making recommendations. That ultimately, I do believe, means that we are fulfilling our responsibility under consumer duty as well. We're protecting the client, and also, there's going to be a financial reward off the back of it. But yeah, I think focus on living in your circle of influence would be my biggest sort of tip, if you like.
And I do appreciate I put you on the spot there, but I think it was relevant. And you've talked about the GI, you talked about a really sort of really good points there in terms of future-proofing your brokerage, which is what this is all about. And I think that's like it is. And I understand If you're an employed broker, there's only so much you can do within that. If you're a self-employed broker working within a business as an RI, there's a certain thing you can do within that as well. If you are self-employed, running your own business or whatever, and it's your name above the door, then there's a lot more you can sort of do about that as well. And I think because people that are transitioning, people that are moving from RIs to BARs, there are people that are moving from various different things, employed to self-employed, all those kind of things. I think just hearing it from you and your position and your experience and what you're guiding people going through, Jonathan, is quite sort of, it's good giving people that clarity to think, actually, what would Jonathan do in my situation and what would Jonathan be doing? And I think that sort of, from what you said there, those top tips, shall we say, from what were the Viz ones? I'm trying to think what the Viz thing came to my head then, from the 80s comic or 90s comic or whatever, it's still around, I think. But I think Jonathan's top tips there, whether we Patterson that or not, I don't know, but I think it's just relevant to then thinking, actually, this is where I need to start, and having those honest conversations with yourself about circle of influence, about the website, about social media, about your shop window, are all relevant, because you've got to have the been awareness of that and thinking, actually, if it steps you out of the comfort zone, if it makes it uneasy for you, if it does seem hard to swallow, wrapped around all this is what you said. It's about being brave.
Yeah.
And that's the thing with all this, you've got to be brave.
I'll give you a mic drop moment to close it off. And,
To end on,
yeah. So this is kind of relevant to operating within a self-employed environment. But I remember when I sort of first transitioned from employed to self-employed, somebody once said to me, when you go to work, make sure you work. And I know that sounds fairly obvious, and you're looking at me a little bit, within a self-employed environment, if we're at work, let's make sure that we're doing something productive that is making a difference to our business. Otherwise, go and do something else. Don't pretend.
No.
And I think there's sometimes a lot of that goes on.
And I wasn't, when you sort of said that, because we've not spoke about it before, you've never said that to me before, I was just processing it, because actually that is just so like, it is so real. It's literally, if you're employed, it's a case of starting work at a certain time and you're working till the end time of the day, kind of whatever that looks like. And if you can scroll and if you can sort a few other things out while you're getting away with working, whereas when you're self-employed, work. And when you don't need to work, don't work. Don't busy yourself. Don't do it. Don't feel guilty. Don't do it. Mate, perfect ending. Thank you so much for coming back onto the podcast. We'll get you on again, no doubt, very, very soon.
Cheers,
thanks for your opinion.
Thanks
for your honesty. Yeah, and now I will see you soon.
Yeah, cheers, mate.
Thanks, Jonathan. Thanks for being an amazing guest as always. Thanks for agreeing to come back on. Thanks for agreeing to trust me with no agenda, and really giving your honest feedback in terms of the mortgage market, the world of mortgage broking, mortgage advising, and what the future looks like. And really the hints and tips that you shared, really useful if you're thinking about going self-employed as a broker or setting up your own firm. I think it's relevant to people within the industry in terms of the changes that they're looking to make. Thanks as always for agreeing to be a guest coming back on, and I'm looking forward to recording more episodes. So thanks as always for listening. Thanks for subscribing. Any thoughts, comments on the podcast, please leave them in wherever you watch or listen to this podcast. And as always, please do not forget to run your own race.